This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now to talk about the market trade here today, let's say good afternoon to Jim McCormick with agmarket.net joining us. Jim, great to have you back on the program, sir. How you been?
I'm doing well, Jesse. Thank you for having me on. I really appreciate it.
Well, thanks for making the time and being with us again here, Jim. Let's dive right in. Tuesday's trade action, another, I'll call it a risk-on day in the grain. Strong moves across the board. And bean meal seems to be the leader again here today, along with soybeans. So I think that's something we need to talk about today. But just overall, lower crop ratings here this week. We have a hotter forecast coming up. We have the outside market worries. It feels like everything just combining to give us enough bullish news to move higher here to start the week, Jim.
I would agree with it. I think it's kind of a combination of everything. I think part of it is just also the break we've had through the month of July. We've had a lot of risk off on the markets. A lot of it had to do, Jesse, I believe, with funds that are just choosing to get out of the commodities in general. When the Fed started raising rates in June, and we anticipate them to raise them again tomorrow, that was the signal for the funds to say, hey, time to get out of commodities. Essentially, I'm fighting the Fed. The Fed's goal is to drive down the price of goods, so they exited it. Now it does feel like maybe we went a little bit too far to the downside. You know, the last couple of weeks, there was a lot of rhetoric about all this grain coming out of the Ukraine. As we saw, even though the deal was signed, it's going to be a lot more challenging than I think people were thinking. Actually getting the grain out. I think another Odessa was bombed over the weekend. I think another port city was bombed last night. So I think you're getting a little bit of war premium maybe putting back on, realizing we're probably going to get some grain out of the Ukraine, but we're not going to get 5 million metric tons a month like we were pre-war. And then on the weather side of the equation, maybe took a little bit too much weather premium out, being the fact we still got some summer to go. So, I mean, those are definitely things that are kind of attracting buyers back into the marketplace.
Well, let's break things down a little bit more. Let's start with that soy complex. Meal's been really strong the last couple of days. I'm wondering if maybe some of that is anticipated demand from China with their hog herd increasing. I'm not sure, so I'll ask you, what are you seeing in this bean meal market? Because it really feels like that's been the bullish star of the show to start the week, Jim.
Well, I think part of it, Jesse, was the fact is the very popular trade early in the year was to buy oil, sell meal. They were buying the oil on the veg oil trade, buying oil on, not being able to get the palm oil, the sunflower oil out of the Ukraine. So, and then as well as just the energy component of it. The energy market continues to be under pressure for the most part as people are fearing the recession. So I think you're seeing a lot of unwinding of that spread, which is driving the price of meal up. The other thing I think you're seeing also what's going on, maybe hand in hand with the beans. Look at the August bean market doing. It's really running hard today. And I think that might have to do with the heat that's coming in. Some of these midday models, now it's raw data. We're putting 100 plus degree temps in parts of the Dakotas, Iowa, even creeping to Illinois toward the end of next week. And I think you have some producers out there that are very worried about what type of crop or what size of crop they're going to have in the beans. And all of a sudden, it's getting a little bit harder to get those last beans out of the producer's hands to bridge them for these end users and meal processors to bridge them to the new crop. So I think you're seeing a little bit of a squeeze, and maybe you're seeing a little bit of short covering, fearful that there are going to be some deliveries, people essentially trying to demand delivery as we go into the first part of August.
That's a great point. And on top of that as well, we talked the heat in the Western Plains. I've even heard some rumors, some guys in the Eastern Corn Belt, they're not too happy with how their soybeans are looking so far either, because maybe they've gotten a little too much rain in some spots, Ohio, Indiana, etc. So I think there's a double-edged sword of worries out there for the soybean crop right now.
Well, there's definitely a double-edged sword, as you put it, simply because the big problem is there is no room for error. Remember, in July, Jesse, they managed to get that new crop bean carry out to grow to 230 million. How did they do it? They did it by cutting demand dramatically. They cut exports roughly 60 million, and they also cut crush, old crop, and new crop by 10. And they did that because they knew they were losing production due to the loss of acres. And that managed to hold that carryout at about 230 million. But what happens is you lose a bushel off these beans due to this heat, and all of a sudden your carryout's now down to 150. You'll lose another bushel and drop this, production down below 50 bushels an acre. All of a sudden, this market is going to have to go into a rationing mode until we see what type of crop South America has. So, this is something a little bit of a concern. And like I said, I think last week we might have took a little bit too much weather premium out of the market, and I think we're trying to put some of it back in here in the last 24 hours, 48 hours of trading.
Jim, let's talk the corn market. December corn closing right at $6 today. I think there's a lot of worry in the trade here watching the corn market. Obviously, the western states, we saw the lower crop ratings. We anticipated that. But I wonder, can Iowa and Illinois hold up the national corn yield if Iowa and Illinois continue to be very good? And obviously, with more heat and dryness and lack of rain, what could that do to the corn crop? Gotten through the most part of pollination here. So you look at this corn market, it felt like the weakest of the three today. What stands out to you? Are some of those things standing out to you? Are you worried? Are you worried that Iowa and Illinois might not be able to carry the national average moving forward?
I don't believe they can. I started with the weakest first. Yes, I think it was kind of the weak leg of the grains today. Beans are definitely going to be the leader. I think the trade's taken that. August is going to be bean month, and we are getting pretty much through the critical pollination phase. But if the beans go up, they will help up the corn. Now, as for your comment on the yield, I do think it's going to be a struggle personally to hit the 177 national yield. That would tie last year's crop. And remember, last year to do that, we had 5 states that all had record production. And I know Illinois and Iowa are looking pretty good, but some of these other states are not looking all that good right now. The ratings dropped this past week. I wouldn't be shocked if they stabilize on Monday. But if the heat comes in as forecasted, I'm looking for another drop the week after. So no, I think in general, you're looking at probably a 175 to 176 crop would be if you're going to make me push a number on right now. But, if we're not careful and this heat sticks around too long, we start having poor fill or tip back, and this crop ends up below 174, we're going to be in the same situation as describing the beans, where this corn market is going to have to maybe go into a little bit of ration mode until we see what type of crop the South Americans have this upcoming winter.
Well, and, looking at some of those states that are seeing issues, Kansas, parts of Nebraska, even South Central South Dakota, I think as well into the Southeast, Kentucky, Tennessee, North Carolina, not looking good on the corn crop either. So you look at a lot of those outlier states outside of the I states, and to me, to your point, Jim, $6 on new crop December corn feels like a pretty good spot to lock a floor in and leave that top side open here, just depending on how the weather goes the next month or so.
I would definitely do that. I mean, I think the odds are, if these forecasts holds, I think there's a decent shot we can get a rally. But our group would argue that if you haven't sold a lot of grain, it's a good time to make some catch-up sales, because the reality is this: we're probably going to have enough grain, even if it was down to 174, 175, to bridge us to the South American crop. And if South America managed to have a big crop, there's no reason for corn to explode higher. But, on the macro front, we definitely got some major headwinds. The Fed's more than likely going to raise interest rates on tomorrow's meeting by at least 0.75 of a point. Then we have the GDP number on Thursday. All likelihood, if we're not in a recession, or at least a second quarter of negative GDP growth, we're not going to see anybody robust growth. The pessimism is really negative around the world right now. So you're going to see, the overall economy struggle. When that happens, it tends to be negative for commodities as well.
Well, talking a little bit more about the outside markets, Jim, that Fed meeting, do you anticipate, it feels like the trade has done its best to price in a 75 basis point rate hike. We have the recession fears, but who's to say the Fed doesn't come back here and say, give us a higher rate hike, give us a full 100 basis point rate hike. Do you anticipate a surprise for the Fed tomorrow by chance?
I don't. I think they're going to keep it right around 0.75 of a point. I mean, part of the reason why I think, early on, Jesse, when we had the last rate hike last month, I think that was on the books. But if you take a step back, what essentially has happened since that last rate hike, look at the price of crude oil. Crude oil was trading at a high of 130 on the night of the war. They've been trading around 120. It's now down in the mid to low 90s. So the crude oil price is dropping. Look at the price of gasoline. It's dropped over $1. So you're seeing the energy prices come down. Look at the price of grains. Beans are trading over $18. Corn's trading over $8. Wheat was trading at 14. So the grain price is coming down. I know around here you're starting to see house levels that are trying for sale. Those prices are being cut as the interest rates are going up. So when you look at what the economy is doing, it is doing what the Fed wants. The Fed, by raising interest rates, they are trying to put the brakes on the economy to slow down demand. And we're seeing that. Walmart had earnings yesterday, if you notice. Their earnings, they were still profitable, but they weren't near as profitable as Walmart wanted it to be, because what's happening is people are no longer buying the high margin goods. They're tending to buy more food, which has less margin. So what's happening is they're slowing down consumption, which is what the Fed wants them to do. So I think, by raising them 0.75 last time around, doing it again this time around, I think the economy is slowing down enough that's going to have them, they don't have to shock the market with a full point. But the fact is, it is a Fed. Whatever number we're going to get, we're probably going to get some volatile reaction, no matter what number they give us.
The wheat markets, real quick, Jim. I think the wheat markets, to me, feel like they're in a little bit of a holding pattern to slightly bullish. It feels like maybe putting some premium back in, some risk premium here, waiting to see what we get out of Ukraine. I know as well, U.S. wheat still not cheap, but still not cheap enough for folks like Egypt to buy. But watching all these factors, we have a spring wheat tour this week, wondering what we'll see there, which should look fairly decent. To me, it just feels like the wheat markets are maybe holding a little bit for some more concrete news. What do you think?
I think you nailed it right there, Jesse. I mean, I couldn't say it better. They're holding support right now. I mean, we've had a little bit of a triple bottom on the charts, but they're trying to bounce off of it. We are some of the cheapest wheat in the world. We'd like to get some more demand coming our way. If the dollar would weaken, that would help a lot. But we are, we're cheap. We're not, like I said, we're getting competitively priced. I think the world is coming to terms right now that we're not going to get a lot of grain out of the Ukraine. Now, I do think right off, you'll probably see quite a few ships come out relatively quick. There's roughly 80 ships supposedly that have been locked up in Ukraine due to this war for the last 5 months. I'm guessing those ships and those crew want to get the heck out of Dodge. The moment they can get out of that country, they're going to go. And that will be bringing wheat and some corn to the rest of the world. But then the real question is, who's going to go back into a war zone? You got to find a crew. You got to find a captain. You got to find somebody who's going to insure that boat to go into that war zone. And I just think that's going to be a very, very hard situation to, get through, plain and simple. So I think the world is, kind of priced in way too many bushels coming out of that country. And that, I think that will hopefully, as people realize that, I think the odds are high that's going to bring some demand back to the United States when they realize they're not going to be able to count on the Ukraine.
Let's talk livestock a little bit, Jim. Start with the hog market. It had been a pretty bullish run there. We have backed off just a little bit here to start the week. In August, that kind of getting in line with cash now and the futures, but still, this hog market's been pretty impressive the last couple of weeks. What's your thoughts there, Jim?
Well, it's been pretty impressive. I think maybe at least near term, the near term runs maybe down, sideways to down. We had that big key reversal in some of the contracts yesterday, and I think that was a technical indicator. Maybe we've overdone it a little bit. I think it's going to be more of a sideways type of chop right now. I mean, the reality is, the supply is going to continue to tighten up, I believe. But the big thing is we got to get the Chinese to come in and buy a little bit more pork. And there's a lot of political tensions right now in China. You have Nancy Pelosi that's trying to go over to Taiwan, and that's kind of got the Chinese a little bit upset with us. But on the other hand, you got President Biden also talking about maybe relieving some of the tariffs that President Trump had put on as a way to essentially ease the inflationary fears or pressures on American citizens. Because remember, when we put tariffs on people, it does not penalize the Chinese. It penalizes the buyers. Because 99.9% of those buyers, whatever that tariff they have to pay bringing that product into the U.S., they pass it directly on to the end buyer. So we'll see where that plays out. But I think that's probably the next thing for the hog market would be to see maybe China come in and be a little bit more aggressive. That also has to do with their economy. They're definitely kind of putting a stranglehold on their economy, in my opinion, as they continue to do these COVID lockdowns. So if their economy could stabilize, that would probably also just help the overall psychology of the hog market.
And how about the cattle market, Jim? What are your thoughts there as we work through this week?
I think overall it's continued to be more of a sideways market. It's been in sideways for a while now. I think in general it's holding in there pretty well. I mean, near term, we've got a lot of cattle being dumped on the market as they're trying to get rid of cattle due to the extreme heat. But, in the long run, you look at the supply of cattle, it's going to tighten into the end of the fourth quarter, into 22, 23, assuming we don't go into a really negative recession. And I really don't think we will. I mean, the reality is over the last couple of months, we've been actually hiring people at a pretty ferocious pace, even though the economy's been slowing down. So hopefully, if we do have a recession, it'll be relatively shallow, and that'll keep the beef demand relatively supportive.
Well, Jim, fantastic stuff. Any other final thoughts for us? The floor is yours before we wrap it up for today.
Well, I think right now, a lot of producers are very upset, especially in the grain market, that they missed the rally. This sell-off we had in mid-July was probably a lot harder and a lot faster than a lot of people thought it would. It wasn't your typical weather break. It was a weather break combined with funds exiting these speculative positions due to blowing up the inflation hedge. It looks like these weather models hold. We probably got a shot at putting some weather premium back into the marketplace, but I would encourage producers to use a nice rally back up, a kind of retracement rally points up here to try to lay off some risk. Because like I said, in the broader picture, the economy is definitely slowing down, not just here in the United States, and that tends to be negative commodity. So you don't want to let this second chance rally get away from you, if all possible.
Well, Jim, if producers want to reach out to you guys for any advice, I know they can find you very easily, agmarket.net, or they can give you a call, can't they?
Exactly. But I'm going to encourage people to go to agmarket.net and subscribe for a free trial of our research, or go to the app, agmarket.net, or go to any of the Apple or Google stores and download our app.
Well, with that, we appreciate the time as always. Jim McCormick of agmarket.net. Thank you for joining us today, sir. Have a great week, and we'll talk to you again soon.
Thank you again for having me on, Jesse. Appreciate it.
And that's going to do it for Market Talk today. Find us online, markettalkag.com. I'm your host, Jesse Allen, wishing you a great afternoon.